The world's supply chains are again being rattled. In early October 2025, the Dutch government seized control of Nexperia, a Chinese-owned chip maker that supplies semiconductors to automotive firms across Europe and the United States. Beijing retaliated by halting exports of certain finished components and sub-assemblies from Nexperia's Chinese plants, triggering fears of a massive production halt at European and U.S. car factories. The European auto industry already accounts for roughly 7% of the region's GDP and provides about 13.8 million direct and indirect jobs. This isn't just a supply hiccup, it's a fundamental test of industrial strategy, geopolitics, and economic diplomacy. As Europe scrambles, American markets have lurched from optimism to panic. US President Donald Trump has swung between threatening 100% tariffs on all Chinese imports and insisting they're not sustainable. His posts accusing China of an economically hostile act for not buying US soybeans and threatening to ban Chinese used cooking oil imports illustrate how trade policy is now made in real time via social media. Each post sends stock indices soaring or crashing. Caught between these policy gyrations, central banks are quietly dumping dollars for gold. Bullion has overtaken the euro as the second largest reserve asset after the US dollar, reflecting a profound loss of confidence in the US political system and a broader global movement away from a dollar-centric order. This deep dive unpacks how Europe's missteps, America's tariff roller coaster, and the global rush to gold are deeply interconnected. We will explore the chain of events, analyze the economic stakes, and ask whether we're witnessing the early stages of a new economic order. Europe's chip crisis, how a Dutch decision threatens millions of jobs, the seizure of Nexperia. In September 2025, the Dutch government invoked a rarely used law to place Nexperia BV, a semiconductor company owned by China's Wingtech, under state control. The Netherlands cited concerns that technological knowledge could be transferred to China and pointed to Wingtech being on the US entity list. Court documents later revealed that the seizure followed months of rising US pressure and a new US rule restricting exports to any company that is 50% or more owned by a sanctioned entity. Wingtech owns 100% of Nexperia, so Washington's expanded controls effectively forced Dutch intervention. This move was extraordinary because Nexperia is not a niche player. It is one of the world's largest suppliers of simple, discrete chips, diodes, transistors, and other building blocks used in cars and consumer electronics. Wingtech bought Nexperia for $3.6 billion in 2018, integrated its operations, and invested heavily in packaging capacity inside China. The company packages billions of chips every month and is the main supplier for many European car makers. When the Dutch took control, Beijing responded by banning the export of specific finished components and sub-assemblies from Nexperia's Chinese facilities. Cascading disruptions. Within days of the export ban, Europe's auto lobby ACEA warned that the chip supply interruption could significantly disrupt manufacturing. Car makers and their suppliers received notices from Nexperia saying it could no longer guarantee delivery of chips. The Alliance for Automotive Innovation, representing General Motors, Toyota, Ford, Volkswagen, Hyundai, and nearly all major US automakers, urged Washington and Brussels to resolve the dispute quickly. Its CEO John Bozella cautioned that if shipments don't resume soon, US auto production could be disrupted as early as next month. Some automakers quietly told reporters they were bracing for shutdowns. Europe depends on these seemingly humble chips because today's cars are rolling computers. Electronic control units manage everything from fuel injection to braking. Without a steady flow of diodes and transistors, assembly lines grind to a halt. It's a stark reminder that in the modern economy, supply chain choke points can emerge from the most unexpected corners. Pillar of the European economy. The impact goes far beyond assembly lines. The European automotive industry supports about 13.8 million direct and indirect jobs and accounts for 7% of Europe's GDP. An official European Commission fact sheet notes that 2.6 million Europeans work directly in motor vehicle manufacturing, representing 8.5% of the EU's manufacturing workforce. When suppliers, dealerships, and related services are included, the auto sector provides 13.8 million jobs and about 6.1% of all EU employment. This makes the industry one of the continent's most important sources of income and innovation. Yet Europe has been losing ground. A 2025 McKinsey study highlighted that European automakers have lost more than 13 percentage points of market share since 2017 and that their profitability has fallen dramatically. Much of the decline is due to supply chain vulnerabilities, competition from China's electric vehicle giants, and shifting consumer preferences. The Nexperia crisis exposes just how fragile Europe's industrial base has become, and how decisions taken in The Hague or Washington can ripple through factories from Stuttgart to Detroit. Geopolitical backdrop. Beijing has framed the Dutch intervention as 21st century piracy and a violation of property rights, recalling the era when Dutch traders dominated global commerce through the East India Company. Chinese state media have warned that Europe's moves undermine trust and may invite broader retaliation, including limits on rare earth exports. While these accusations are couched in propaganda, they underscore a deeper trend. Economic security is now entangled with national security. The United States wants to prevent China from accessing advanced technology. Europe fears being caught in the middle. Beijing feels encircled and responds asymmetrically. America's tariff roller coaster, tweets, tariffs, and turmoil. Threat of 100% tariffs. As the chip dispute simmered, Washington added fuel to the fire. Early in October, President Donald Trump announced he would impose a 100% tariff on all Chinese imports starting November 1st. He paired the tariffs with new export controls on critical software and said China had to lift its rare earth export restrictions or face these penalties. Markets plunged. Analysts noted the announcement triggered the steepest decline since the April Declaration of Economic Independence when he first floated high tariffs. 2 days later, Trump reversed course. In an interview, he admitted the 100% tariff is not sustainable and insisted he still hoped to reach a fair deal with China. He also confirmed he would meet President Xi Jinping in Seoul within weeks. The whiplash forced traders to scramble. On Sunday, he tried to calm markets by posting, "Don't worry about China, it will all be fine." And stock futures rebounded. A single post reversed billions in equity values. An economically hostile act. Trump's trade offensive hasn't been limited to tariffs. On October 14th, he accused China of purposefully refusing to buy U.S. soybeans and called this an economically hostile act. In the same post, he threatened to ban Chinese imports of used cooking oil, a feedstock for biofuels. China supplies roughly $1.1 billion of used cooking oil to the United States, while U.S. soybean exports to China were about $12 billion last year. Beijing dismissed his remarks as political theater and urged consultation instead of confrontation. The market maths. Financial markets have become hostage to presidential messaging. In October alone, the S&P 500 swung by more than 100 points multiple times as investors tried to guess whether tariffs would stick or fade. When Trump threatened 100% tariffs, retailers and manufacturers warned of price spikes and supply disruptions. A survey found that 43% of U.S. businesses would need 7 to 12 months to adjust their supply chains if tariffs were imposed. Even giant retailers like Walmart, where about 60% of products were imported from China in 2023, have been forced to rethink pricing and inventory. When corporate executives can't plan, workers worry about jobs, and consumers cut back on spending. Trump's apparent strategy is to use economic pain as leverage. He believes China will only respect strength and that compromise signals weakness. Yet his inconsistent messaging has shaken confidence in U.S. policy. It also undermines negotiations by suggesting there is no fixed position. This unpredictability is why central banks and investors around the world are looking for safer stores of value. The flight to gold, a response to uncertainty. How central banks are hedging. Amid the trade chaos and geopolitical risk, central banks are buying gold at record rates. They purchased over 1,000 tons of gold in 2024, twice the average of the previous decade, raising global holdings to 36,000 tons, just shy of the 1965 peak. As a result, gold has overtaken the euro to become the second largest reserve asset after the US dollar. Bullion now makes up roughly 20 to 27% of global reserves, while US Treasury bonds have dropped to about 23%. This reflects inflation worries, geopolitical fragmentation, and declining trust in the dollar. Gold prices have smashed record highs, reaching nearly $4,000 per ounce in October 2025. At that level, central bank holdings are valued at $4.5 trillion, more than their U.S. Treasury portfolios. Dollar share shrinking. The flip side of rising gold reserves is a declining dollar share. The dollar's portion of global foreign reserves has fallen to around 40%, down from more than 70% in 2000. Economists say the steep drop is driven by deglobalization, unilateral sanctions, and political dysfunction in Washington. While the dollar remains dominant in trade invoicing, its erosion at the margins signals a slow shift toward a multipolar reserve system. Why gold, not crypto? Some analysts argue that the United States could move its debt into a crypto cloud and devalue it. Others suggest Washington should sell its gold and buy Bitcoin. But central banks aren't listening. Gold's appeal is that it has no counterparty risk. Unlike crypto, it doesn't depend on an underlying payment network, and it isn't subject to regulatory whims. While Bitcoin attracts retail and some institutional investors, central banks stick with what they know, an asset that has anchored monetary value for millennia. Return to the 1970s. The current rush resembles the 1970s, when inflation, oil shocks, and geopolitical turmoil led to massive gold accumulation. Today's drivers are similar: war, sanctions, high debt, and collapsing trust in institutions. But now, the US itself is viewed as a source of volatility rather than stability. By flipping between protectionism and conciliation, Washington is undermining the very system it created after World War II. Bigger picture, toward a multipolar economic order, the feedback loop. What links a Dutch chip factory, a soybeans tweet, and record gold purchases? The answer is a feedback loop between policy missteps and market reactions. Europe's seizure of Nexperia, arguably under US pressure, triggered Chinese retaliation that could shut down auto plants on both sides of the Atlantic. Meanwhile, America's erratic tariff threats unsettle markets. That uncertainty fuels the movement out of dollar assets into gold. As gold demand surges, investors interpret it as further evidence of de-dollarization, prompting politicians to double down on trade brinkmanship. The loop feeds on itself. China's quiet advantage. In this geopolitical chess game, China's smartest move has been to do nothing rash. While Washington and Brussels roil markets, Beijing plays a long game, investing in semiconductors, critical minerals, and global influence. European carmakers are lobbying the Dutch government to reverse its decision, and some US automakers are considering shifting production to Mexico or Asia if chip supplies remain unstable. Implications for the global order. If current trends continue, we may see the emergence of multiple regional blocs, each anchored by its own currency and supply networks. The US, EU, and China could become three competing hubs, with smaller countries aligning based on geography, technology access, and commodity flows. Gold would serve as the neutral bridge between blocs, the asset everyone trusts when they don't trust each other. Such a world might be more resilient in some ways, but also less efficient and more prone to sudden shocks. The past few weeks have illustrated how interconnected the global economy is, and how easily it can be destabilized by unilateral decisions. Europe's seizure of Nexperia, taken in response to US pressure, threatens to idle factories across the continent and in America. The European auto industry, which provides millions of jobs and around 7% of the region's GDP, is at the mercy of tiny components produced half a world away. At the same time, US trade policy seems to be crafted on social media. The threat of 100% tariffs, followed by partial retreats and erratic posts about soybeans and cooking oil, has created a volatile environment where stock markets rise and fall with every tweet. This unpredictability undermines confidence in the dollar and drives central banks toward gold, a metal that now comprises more than a fifth of global reserves and is climbing toward a third. In this new era, economic security is inseparable from geopolitics. Decisions made in The Hague, Washington, or Beijing reverberate through supply chains, financial markets, and central bank vaults. For policymakers, the lesson is clear. Short-term populist moves can have long-lasting global consequences. For investors and citizens, it may be time to understand that the world is shifting toward a multipolar order where the old certainties no longer hold. Whether that leads to more stability or more fragmentation depends on how wisely the next decisions are made.